In Canada, you only need to know about one ETF to secure yourself a safe and worry-free financial future. In this video, I will share an advice with you that will easily beat any fee-based financial planner, individual stock picking, high-interest savings account, or crypto. We Canadians have quite a few interesting and solid ETFs to choose from. And doesn't matter how many videos you're about to watch on this topic, you will always end up with pretty much three most popular options. It's either VEQT, XEQT, or VFV. The algorithm is gonna hate this, but let me save you the time and just outright give you the only ETF you need to know about to get the highest return on your investment and the one that you can basically hold forever if you'd like to take advantage of the compounding over time. Let's go over why I believe VFV to be the safest approach as far as the investments go, with stats, historical examples, my own portfolio example, all of which will be shown in this video. Let's get straight to it. What is VFV? VFV is a Vanguard fund that tracks the S&P 500 performance. In layman terms, you're betting on the US economy and its 500 strongest, best performing companies. It is very similar to just outright investing into the S&P 500, just a tad easier and a little more straightforward as it bundled up for Canadians and is represented already in the Canadian dollar. Historically, it has been one of the best investments one can make, as the S&P 500 had returned 10 to 11% annually on average in the last 50 years. Now, let's talk about the most recent stats to make it more relevant and easy to understand, a little bit more straightforward for everybody. If you had invested $10,000 precisely 5 years ago in VFV, you'd have $21,500 today. So over 100% growth in 5 years. Just last year alone, VFV returned almost 38%. Sure, it won't happen every year, and some years you might be down, some years you might be up, but again, the average, the math works out to be 10% a year average returns in any scenario, good and bad years combined. Considering that the US economy is currently the best performing and biggest in the world, and there aren't really any indicators that this is going to change in the next couple of decades or in the next decade, I really don't see how any other investment rather than into the S&P 500 could sound more appealing. I mean, you can probably get more if you invest in some individual stocks. Let's say in a hypothetical scenario that you invest in Google today at $195 per share, and then it goes to $400 next year. So 100% growth in a year. It is very likely. Could it happen? Sure. But in a long-term horizon, 10 to 15 years, VFV will still outperform any individual stock that you can pick today. You can win one year, lose the other year, but it's too much hassle. You're always stressed, you're always worrying how your particular stock that you've chosen is going to perform that year. I guess it's just safer and all-around better approach to investing than trying to pick that one individual company that will shoot up, that will do you a 10x next year. It's very unlikely. There aren't many Nvidias of the world, and the fact that you're going to choose one company that's going to do a 100% return in a year or 1000% return in a year is just very unlikely. Let's be honest. As a testament to my competency, I suggest you look back at my older videos from 2022 when I suggested CIBC, where it sat at around $50, or Nvidia when it hovered at around $120 per share, and even Google when it sat at $90. I also suggested back then to all of my viewers to look at VFV when it sat at $92, which now sits at $152. So as you could tell, very solid prognosis, very great returns, especially Nvidia, which returned 15 times. So what am I trying to say with all this? Despite the successful prognosis before, when it came to individual stocks, I have changed my strategy because it was just too much hassle, too difficult to control and actively risk manage 12 to 20 different individual companies at a time. And even if some companies, which is unlikely, will outperform VFV in 1 year, the chances are that in 15 to 25 year horizon, VFV will still outperform most of your individual stocks, while significantly cutting down on risks, on your stress, and saving you the time. Because again, if you have 20 different companies like I do, or like I did, because now I'm switching it all to just VFV and S&P 500 in general, you have to follow every company online. You read all of their financial reports, all of the news, all the partnerships, all the rumors. It's a full-time job. And even though I've done extremely well in the last 4 to 5 years buying individual companies like I did with Google, when it sat at $90, with Nvidia, when it's set at $120, I bought a lot, and I suggested to everybody on this channel to do the same back in 2022 with CIBC, with Manulife Canada. All these companies, I've done very well. Despite of doing very well with them, I've realized this luck, even though I don't believe it's luck, because I've been doing analysis and being very careful before buying. So it's still some work involved, but I've realized that just having 10 to 11% annual return without any risks associated, without any stress, is way better strategy. Because let's say one of the companies that you have goes down, again, receives bad news, has a bad quarter, they have some terrible production issues or whatever, like what happened with Intel, and it goes down 50% in a year. Who needs that stress? Right? The big companies can always go down hard and unexpectedly. And while some will recover eventually, most of the time, some never do, like Intel, for example. Both Canada and the US have more than enough examples of that happening in the recent history. I will probably list quite a few so you can read up on it, but trust me, even the biggest company could fall so fast, you would never predict it, you won't be able to sell it, you just won't have time to sell it. For the most recent example, look at what happened with Bell Canada last year. That could very well happen to any successful company today. So buying a fund that has over 500 of the best performing large cap companies is an easier and all around safer strategy. That's the whole point of this video. Even if the index fund dips, which could happen, say we have a bad recession year and all the companies go down across the board, VFV and the S&P 500 will also drop by, let's say, 10, maybe 20%, but in the long run, it always recovers, unlike the individual companies. And historically, the S&P 500 has always made people money. So let's say in a particularly bad year, if company A drops down by 50%, VFV will only drop down by 5 or maybe 10%. It's all hypothetical examples, but you know what I'm saying. The hit won't be as bad, essentially. Unless there's a third world war on the horizon that wipes everybody out, I don't see how VFV or the S&P 500 could cease existence. Even counting all the bad years, recessions, wars, financial crises, the averages don't lie. The fund had returned over 10% annually since inception. Plus, the S&P Global is always shifting the percentages of the companies the fund includes, often removing some companies and adding new ones, or changing the allocation of their biggest holdings. So it's a pretty active system on its own that doesn't require an investor's active participation, unlike the individual stocks. Now let's see some real-life recent examples to better understand how index fund investing works. If you had invested $10,000 in 2021 into VFV or directly into the S&P 500, you'd have over $20,000 today, effectively doubling your money in quite a short span of time without the risks that individual stocks or crypto involve, which could drop by 80% in a month if it wants to, and there's nothing an investor could do about it. It is highly speculative environment, and sure, it's great for short-term plays or for some people who like to gamble, but this channel is about investing, not gambling. Another benefit of this strategy: you won't have to pay any fees since you're basically managing all of your investments yourself. Forget about the 1% management fee you would usually pay for an advisor, or 5% fee for the robo-advisor, like what Simple does, for example. The ETF is being managed by the company already, which is the Vanguard in our case, to which you pay a very small 0.09% fee annually. Now compare this to 1% annual wealth manager fee, who can't even guarantee the same returns in most of the situations. Not very good. And I really believe you should just invest it and manage it yourself, so you don't have to pay any fees besides that 0.09% management fee. Thanks for watching. Let me know in the comments if you have any questions or if you'd like me to clarify on some things. Be happy to do it. Leave your opinion. Let me know what you thought about my strategy. Maybe provide your own examples. Would be happy to participate in the conversation, or reach out on Instagram in direct messages. Would be happy to talk to you guys, and I'll see you in the next one. Ciao.